Hello everyone, my name is Evan. Welcome back to episode 3 of Beyond the Charts. If you've never caught an episode of Beyond the Charts, it is our research series where we ask a question about the market. We then write some code to answer that question, gather market data, and then run our code against historical market data. The goal is to come away with some meaningful results, or at the very least, leave a little bit more informed than where we started. Now, a couple of housekeeping notes. I'm going to do away with the heavy sort of coding section in this episode. So in the past few episodes, we spent some time writing code line by line, sort of walking through just how to program and how to code some of this. I don't think there's as much interest for that, so I'm going to write everything ahead of time. We're going to briefly just overview it at the start. I will still publish the file, the code, to our GitHub account, so for you developers, for you NinjaTrader users, you can still download everything, run it on your machine, and duplicate everything that we do here. As always, there's going to be timestamps in the description of this video, so you can check the description, jump around if you'd like. And we're also going to make this available as a blog post, so if you prefer to skim and jump around, you can do that as well. There should be a link appearing in the top of the screen right now. So hopefully that sounds good to you. Let's jump into today's episode. Today we're talking stop losses, specifically intraday stops versus end-of-day stops. Now, if you're not familiar with those terms, let's start off with some definitions so we're all on the same page. A stop loss refers to the point at which you're going to exit a trade. Usually, this means when the trade doesn't go in your favor. So you can think of it as a bit of an insurance policy. You know, if you want the stock to go up, but the stock goes down, you have to decide what's your stop point, where are we going to stop the losses from occurring. That's where that level or that condition comes in. Now, intraday versus end of day. Intraday is what is pretty standard. It is basically real time. When the condition happens, you get out, right? So if it's a certain level, Apple at $100, if Apple trades below $100, I want to be out of the stock. As soon as that happens real time, that's when you exit. That's an intraday stop loss. That is the term we're giving it. Now, end of day is where things are a little bit different. Now, end of day is really for traders that are holding positions overnight. And so end of day stops mean that the stock has to close the session, has to close the day beyond your stop loss. That's the point at which you're going to say, okay, the stock closed below the level, I will now exit the trade. So you're not looking at just an intraday real-time stop. It needs to actually close below your stop loss. It may seem interesting, maybe insignificant to you, but it actually does matter. And I remember way back in the day when I was kind of building and developing my trading system as starting out, having a big poster sheet I put on the wall, column down the middle, pros and cons, and really sort of wrestling with this question, which is better? Is it better to have an end of day stop or an intraday stop? And, thinking about all those deciding factors. And in this video, we're going to hopefully get right down to the data level and just objectively look what makes more money. Now, let's just do one more quick illustration here so we're all on the same page. Let's just model out the intraday and the end of day stop before we get into our experiment. So let's assume we have a position here in Google. Okay, we're long the stock. We've enjoyed this nice rally higher. And now we say to ourselves, okay, it's time to protect our profit and we need to put our stop loss in place. And you should always have a stop loss in place, of course, but let's assume we're just putting it in for the first time in this example. So we do some technical analysis and we say, okay, 1490, that is the price at which we are going to exit Google. That is our stop loss price. Okay, so let's model what a intraday stop loss would look like in this scenario. So if we flash forward to the next day, you can see Google trades below 1490. So it trades beyond our stop loss. And what this basically means is this triggers in real time. And so our price at which we leave and exit this trade is the 1490. Now, of course, there's really some slippage there, and we're going to just ignore that for now. We're going to assume we got out at 1490. When we run our experiments later, we're going to account for slippage. But let's assume that we don't we don't have any here, and we're out at 1490. Okay, so let's reset this example, and now let's sort of model out what happens on an end of day stop basis. So same thing, we put our stop in place 1490. The next day, right, we come back to our trading terminal after the market's closed, and we look at what happened here, and we say, okay, Google closed below 1490. It is time to get out of this trade tomorrow morning, right? Because we waited for the end of the day. The end of the day closed beyond our stop. Let's get out tomorrow morning. So we flash forward to tomorrow morning, and we realize something big happens. Google gaps down 40 points down to 1423 and 5 cents. That's the opening price of the day, and therefore that's where we exit the trade. So this is clearly a very big difference, 4.5% difference. So the intraday exit versus the end of day exit gives you a very different result. Now, this is obviously an extreme example. It doesn't always have to be like this, but this shows that there is a difference in your stop loss sort of methodology or execution strategy. Sometimes the end of day can work in your favor. So it doesn't always have to just be bad. And so that's exactly what we're going to explore in this experiment. So hopefully that sounds good. Be back in just a moment here with some code. All right, we're back. We've got NinjaTrader 8 open. That is the software backtesting platform that we're using. It's the same platform we used in the last couple of episodes. So we're continuing with it. And what we're actually doing is going to build on top of episode 2 of Beyond the Charts. So that was our 52-week high breakout system. So when stocks hit new 52-week highs, when they closed at new 52-week highs, our strategy would buy, and then we would set various trailing stop losses. And our experiment last time was to find out if buying 52-week highs was in fact profitable. Broadly speaking, those results confirm true that that strategy did make money over time. So what we're doing here is we're going to take that same exact framework. So when stocks break out to new highs, we're going to buy. And now instead of having a trailing stop loss that is based on intraday or real-time stop loss, we've implemented it so it will execute on the end of day method. So it's going to look to see if this bar closed below our price. And if it did, we are going to exit on the following market open. So that's sort of the comparison. That's the framework we're using here. And I've got in front of me the code. It's already written entirely. So remember, I'm going to post this to our GitHub account so you can download it. The big changes here. So remember, this is episode 2 framework. And really what changed in this week was the buy sell rules. So lines 109 to 132. Specifically, though, it's really lines 118 to 130. So this was really the code that got added here. And what this is basically doing is just checking whatever the highest price is. It's setting our trailing stop loss every single bar that goes through. And then if it happens to be true, we exit the next day. So that's about the extent that I'll cover this. I'm not going to go too deep into code like we did last time again, but it's definitely here if you're interested. And again, leave a comment below. I'd love to know if my assumption's correct. Like, do you want to see more code? Which was that interesting to you to kind of learn how to replicate this yourself, or do we mostly care about the experiment? Leave a comment. I'd love to hear it below. So now that we've got that covered up, let's take a look at the strategy itself. So what I'm going to do is take this code and now run it against historical market data. Same thing we did last time. We're going to use the Dow Jones, and we are going to run it on the survivorship bias free. So that basically means all the stocks that existed in the Dow Jones will be in this test as well. So there's no sort of sampling bias there or anything that would be out of the ordinary. And let's just look at a couple of examples before we look at the actual results. So this is the strategy run. So you're seeing all the buys and sells here of what the strategy is doing. So for instance, right in here, it's buying at 52-week highs. And then this is in this case, a 5% trailing stop loss. It's now out at that price. Same thing here, new 52-week high. 5% trailing stop loss, 52-week high. Nice run here for Microsoft back in 2019. And then you can see it exiting over here. And you can see again, it's executing on the next bar open. In all of these examples, if we go to a few more here, let's see what we can find. So here we go. New 52-week high. We see this big gap down. Exits the following day. Let's see what else we got here. Very similar action. This one caught a nice trade in here. So you can see stopped out at the 5% trailing stop from high and then exited. So on and so forth. What we're going to do now, though, is we're going to take this strategy and compare it to basically last week's. Is the intraday or is the end of day more profitable? And that's the results we're about to look at. All right, here it is. Here's the good stuff. These are the results of the trading strategies. So what we did is we ran through a bunch of different simulations in NinjaTrader. We exported that data into Excel and we ran it through our sheets, which basically clean things up and help kind of display everything in a nice, neat, orderly fashion. So we did this with a few different distance stop losses. So the first case that we're going to look at is actually a 1% trailing stop, which is extremely tight. Sounds absurd, kind of is absurd, but when you're sort of testing things, usually the extremes are where you kind of get the insights. So when you look at very extreme cases, when you're trying to compare, in this case, intraday stops versus end of day stops, that's where you can start to see how things really behave much differently. And then we are going to look at a middle of the road case as well. So we're starting things off with a 1% trailing stop. So stock hits 52-week highs, we buy long, 1% trailing stop, and we now are analyzing the results. This is the intraday trailing stop. So this is basically the same exact strategy from episode 2. And we're running it over 20 years of data. Dow Jones, survivorship bias free, Norgate data. Got a link here to Norgate, good partners of ours. They do great work over there, love their data. If you're looking to backtest things, test things out yourself, I highly recommend using their data feeds. So here are the results. There were 11,000, we're on row 4 here. There were 11,320 trades taken. There's a ton of trades, because remember, this is only the Dow Jones, so you only got about 30 stocks in there. So that's a lot of trades over 19 years. Reason is because the stop loss is only 1% away, so you're going to continually get sort of whipsawed out of the trade. Average hold time, 0.62 days. So you basically get in and you're getting in on that day, and then you're getting out basically that same day because you're getting in and getting stopped out. Cumulative R, that's how we're measuring performance here. We're using risk multiples, is minus 4,571. So let's take a look at that equity curve. Here is what that equity curve looks like. So this is what happens if you were to buy breakouts and put a 1% intraday trailing stop loss. You basically bleed money. It's not even bleed. You actually lose it just very quick. So repeatedly, basically, you're just losing money day after day, basically, with this type of trading system. So let's go back to our metrics, see if we can figure out why that's happening. So the percentage of winning trades is 5%. So you have a 5% win rate, 5.78%. Average return of winners, 1.26. Average return of losers, minus 0.51. You do have a good average win to loss ratio. It's just a shame that you're losing at 94%. Largest winning streaks, 4 consecutive trades. Largest losing streaks, 250 trades. It's pretty remarkable. And you have some of the largest winners and largest losers there. So, okay, this is the intraday trailing stop loss. This is clearly a strategy nobody on earth would want to run. Now, let's take a look at what happens when we compare this to the end of day trailing stop. All right, and I should have put this on one sheet. In hindsight, that would have been easier. but unfortunately, we're going to look at it on an entirely different sheet. So bear with me. So here are the results for this one. So 5,700. So let's see if I can just drop this down a little bit and look at kind of both at once. So here is the end of day. And we can basically see now 5,758 trades. So you basically are taking half as many trades as the other system. Okay, bear with me on this. Let's get this there. Still running it over 19 years. Average trades per year drops. Average hold time goes to 4 days, 4.6 days. That's an improvement over the 0.62, or at least an improvement is in longer hold. The cumulative R is minus 384. So it's still a negative expectancy, negative return system, but that's a lot less than 4,000. Notice the percentage of winning trades, right? So this goes up to 39.87%. Average winner is still bigger than the average loser. And things look a lot better in this case. So let's take a look at the equity curve here. And you can see that it's something, again, that I don't think anyone would be very interested in trading or owning or using as a trading system. But on a comparative basis, this is far better, right? And that's all relative. But this is far better than the last system, than using a 1% intraday stop loss. Okay, so there's a big difference in performance here when you factor in end of day stops versus intraday stops. And I know this seems like a weird case, and it is, but I still think it's notable because what you're basically seeing here is what the main benefit of an end of day system is, and that is noise reduction, right? You are smoothing out the noise. You are reducing the intraday wiggles and whipsaw, and you are waiting for confirmed price action that the stock has appropriately violated your stop loss. So there is a benefit that you're getting there, and it is in just signal processing, basically, for to use a fancy word. But you're seeing that really sort of play out here in this 1% stop loss example. All right, so let's take it to another example. Let's take a look at a more reasonable trading system, and we're going to go to a 5% trailing stop. Okay, I think that one is probably something that, in fact, we looked at it in episode 2. It did pretty well. So here it is in this light again. This is a 5% intraday stop. Again, 20 years of data. This takes an average of 100 trades per year. Average hold time is 31 days. Here we have a cumulative R that is positive. So here's back to a system that actually makes money. Percentage of winning trades is 38%. Win to loss ratio is 1.94. Let's take a look at this chart. That is much better. That is a 5% intraday or real-time stop loss 52-week high breakout system. So profitable. We discussed it last video, and basically here it is again. These results may look a little different than last episode because we're sampling, I think, throughout the entire year versus last episode. I don't think we had all the way through the end of 2020. So that's what we're looking at. Now, let's bring in the end of day component here, right? Take a guess right now which one we think is going to do better in your head before I bring it in. And here it is. So this is the 5% end of day results. And what we have here is a system that takes less trades. So 1,655 trades versus 2,000, 82 trades a year. Average hold time bumps up to almost 44 days. And take a look at this cumulative R goes to 245. The intraday system is 154. So the end of day 5% trailing stop is once again more profitable. Percentage of winning trades bumps up to 41%. And average winner's bigger, average loser's also bigger. Win to loss ratio stays basically the same. One thing that I think is interesting, and this makes a lot of sense, but if you take a look at the three largest losers here, so if you take a look at really the largest loser is the big standout. So you had a 65% loser here in the end of day stop system. So what that basically means is you probably had a stock that, I don't know, had some big catalyst, some big event. Maybe it was earnings, maybe it was something else, but it had this big gap down. You got the signal to exit, but then it didn't happen. You couldn't exit until the next day, which probably suffered another big follow through gap down, and you took a 64% loss. Compare this to the intraday trading system is only 13%. Now that's important because, again, when you're thinking about systems, you know, everyone on paper is of course going to take this one here because it's more profitable, but there are some things you have to live with, which is a 64% loser. And in the reality of trading is that if you were to hit this in your first month or week or year, even trading this system, that might scare you right out of it, and you may never want to trade it again, even though the data is saying that this is more profitable. So let's take a look at the equity curve here. Much better, right? Much better, a little more sustained. I mean, it's certainly got its dips and valleys, but you know, every equity curve does. Heads up and to the right, more profitable, and does have some very flat stretches here. So again, we're not posing this as a system that everybody should rush out and trade by any stretch. This is simply to illustrate, you know, just basic profitability and compare and contrast these stop loss methods. So there you have it. The 1% stop loss, end of day was more profitable. 5% stop loss, end of day was more profitable. Let's go to an extreme case on the other end. Let's go to a 40% stop loss. So you're going to buy a stock as it hits 52-week highs, and you're going to trail a stop 40% from its high. So let's look at the intraday version first. Bring this in here. And so here we go, 40% intraday stop, 142 trades, a lot less trades. 7 trades a year on average. Cumulative R is 128. So nice and profitable. Percentage of winning trades, 43.66%. Average winners, 114%. Average losers, minus 25%. Great win to loss ratio there. Big winner here. 774% is your biggest winner. Clearly held that trade for multiple years, really. And so if we look at this equity curve here, what you're basically seeing is this is a system. What this is basically saying is you are holding essentially lots of trades for a lot of period of time, and the end of our trading was at the end of 2020, and so the backtest has to end. So the day the backtest ends, it just counts up all the trades and it just sees this big spike. Basically, though, we didn't exit any of these trades, so you're only seeing like a closed, closed trades over time. Basically, it's not a real mark to market on a day-to-day basis, if that makes sense. So this equity curve looks a little wonky. If you were monitoring this day after day, a P&L type of thing, you would see a more gradual uptrend versus this hard spikes. So there you have it. So that's a 40% intraday stop. Let's look at a 40% end of day stop. So here we are, 133 trades. So a little bit less trades. Cumulative R is lower here, and a percentage of winning trades actually drops. And what we also notice here is the largest winners and largest losers basically converge here. They're almost identical at this stage, and all of these other metrics are very similar. So if we go to the chart now, we have a scenario here where, once again, equity curve looks very, very similar. And so you can argue that the intraday system did a little better in terms of profitability. The tough part is because the backtest has to end and you're holding all of those trades, it's a little bit skewed, and I would basically say that it's kind of a wash here. They're both equally as effective, and this is sort of one of the takeaways, I think, with this methodology, is that in the extreme cases, for instance, the 1% stop loss, you clearly saw the big difference of how these two execution exit strategies play out. In the extreme case on the long-term side, the 40% stop loss, you're seeing just the convergence and the fact that it sort of doesn't matter which one you choose at this stage because the stop loss is already so wide, right? So the fact is if you're going to give something 40% worth of room, if you wait till the next day to exit it, plus or minus 1% doesn't really make a big difference when you're already giving it 40% room versus the 1% stop loss. Waiting for the next day, waiting for confirmation is a huge difference. And I think that's an interesting sort of takeaway, an interesting sort of, piece of information that I think we can come away with. So those are the results. Those are the results stacked up in these three discrete specific cases. Okay. So be back here in just a second to round everything out. All right, let's break it all down. Let's recap everything that we learned in today's episode. I'd also love to know what you learned in today's episode. What was your biggest takeaway? And especially if it's something different than our results or what we're thinking after seeing all of these results, leave a comment below. These episodes take a good amount of time to put together. So always just, interested in hearing feedback and also just what you learned and what you took out of this week's experiment. So, end of day stop losses, let's start there. First thing we learned is that they act as a noise filter. And this really sort of illustrated and showed this point in our 1% stop loss experiment. So when we had the intraday stop loss, we saw a 5% win rate. When we put on the end of day filter, it jumped all the way up to about 40%. Still losing strategies, but that's besides the point. What it really showed, though, was the power of, basically waiting for that closing price and, doing away with all of the intraday noise. And brings us to our second point, whipsaw, basically. As we know, as swing traders, overnight holders, stocks move around a lot during the session, right? They dip, they zig, they zag, and they can easily sell off throughout the session. But then by the end of the day, the strong hands sort of emerge. If a stock's in an uptrend, maybe there's some temporary setbacks intraday, but by the end of the session, the accumulation's going on. The people that are participating in that trend end up buying back all that stock and it closes strongly, but there's obviously some there's some in between there, and that's what the end of day certainly helps with. Easy end of day execution. So this was actually one of the biggest selling points for me back in the day. I liked the fact that I didn't have to worry about orders, stops, getting filled, or really just having my mind on the market while it was happening. I could go to the gym, I could take the dog for a walk, I could, leave the house and not be glued to the screens, and I could come back after the market has closed, so all of the frantic action is over with. I can look through my stocks and say, oh, okay, this one closed below the stop loss, this one's still above it, this one is an exit, and then just place, market on sell orders in the morning, and that's it. And basically, essentially manage trades part-time, right, is the way to think about it. Downside is fast markets will catch you off guard. This is the downside of end of day stops. If you have high volatility markets, or if you just own a high volatile stock, or even just a sudden change of character in a stock, right? So maybe something that's working well, but then suddenly there's a big news story that hits a catalyst overnight and this starts selling off very aggressively. If you have an end of day stop, then you're going to sit through all of that intraday pullback, and then you're going to have to wait for the next morning to get out. And that could be very costly during extreme events, extreme circumstances. That's the price you pay for more comfort in the majority of your holdings. Now, on the intraday side, biggest benefit here is it gets you out when and where you want to get out, hopefully. So basically, you put your stop loss in place, you put it in with your broker, and you're getting out. When Apple closes below 100 and that's your stop, that's where you should, in 99% of cases, be exiting that trade. The good news is you can do some set it and forget it, like good to cancel orders. Now, of course, if you're using like sell stop limit orders, sometimes you have to worry a little bit to make sure that you actually got filled on that order, right? So there is a little bit of kind of back of the mind worry and angst, but generally speaking, especially if it's liquid stocks, you can rest assured and you can put orders in and assume that you're going to be getting out of those positions when and where you expect. Last but not least, and the con here for the intraday is it's prone to intraday whipsaws. So the benefit of the end of the day is, of course, the con of the intraday. All of that, volatility, the mess, the turbulence can cause you to exit trades when, the trend and perhaps reason for being in the trade didn't really get validated, or maybe it just got briefly invalidated, but then it goes on to recover. And, stocks have a good way of kind of going all the way down to your stop loss and, kicking you out of a trade and then rebounding nicely. So that's the downside of that real-time protection. All right, on the home stretch here, deciding end of day versus intraday stops. So one of the most important things you can do is test your model. Just like we did here, if you've got the coding chops, writing your criteria, writing your strategy, putting it into code, whatever your entry criteria is, your position sizing, your targets, your stops, and simply just testing what actually makes more money. Let the data drive your decision making. Now, one of the things we learned in this episode here is that the decision is less significant the wider your stops are. So when we took the sort of extreme case on the 40% stops, for instance, those results actually didn't really matter too much which exit criteria you used. Because the stops were so wide, whether or not you waited that extra day, if it was, a 40% exit or a 38% or 43%, doesn't have a whole lot of impact. So that's one thing to keep in mind. And kind of on the other side of the spectrum, the tighter your stops are, the more likely end of day will likely perform better. Remember, this is a single case. Now, I've done some other tests myself, and that generally holds true, but I don't know if it holds true for your specific trading system. So again, I'll defer back to point number one on you ought to test sort of your specific strategy. But generally speaking, if you have very tight stops, end of day typically performs a bit better. That noise filter is usually sort of a good thing, but it's not universal. Now, psychologically, a couple of things to think about. If you're uncomfortable waiting for stops, then intraday is going to be better. And, I know this is on the psychology, so it's easy to dismiss that we're all going to just make the best decision based on the data that we have. But sometimes, whether or not you'll psychologically stick with a system is some of the most important considerations you need to think about. So especially in the case of, the big losses that can come with, the occasional big losses that can come with an end of day system, if you don't think you can handle that or trade through it or stick with a system, then again, intraday is probably going to be better for you. If you get frustrated exiting early, end of the day might be better, right? So if you hate whipsaw, if it drives you nuts when you're holding onto a stock and it sells off intraday and it tags your stop loss, you get out of the trade, and then it just goes right on magically and starts to lift higher. If that absolutely drives you nuts, then maybe the end of day approach is a bit better for you. Of course, kind of oversimplifying both of those scenarios, but I think you understand kind of where it's coming from. So that is it. That's what I got for this week's episode. If you like kind of this research here, or just this process of putting things into code and taking a very data-driven approach, this is what we do with our trading systems. And we do have trading systems available. We got free trials. And so we take our systems, we spend a lot of time looking at historical market environments, looking at how things perform, and building systems that are robust and hold up basically throughout lots of different environments. So I encourage you to check that out. Link in the top right of your screen. And as I mentioned earlier, I'd love to know your thoughts on this episode. Leave a comment below. Tell me what you learned. What was the biggest takeaway? What questions do you have? Leave them below, and I'm sure to get back to you as soon as possible. So thanks so much for tuning in and listening. Make sure to subscribe to our channel to stay up to date with these episodes, and we'll see you in the next update.